Hey everyone, ready for another deep dive into the market? Man, it's been a wild ride lately.
It really has.
Like almost impossible to predict where things are headed next. Feels kind of like, trying to guess which way a roller coaster is going to twist and turn.
Yeah,
And then, of course, we had the U.S. election thrown into the mix just to add a few more loops to the track.
right.
But hey, that's exactly why we're here today, right?
Mm.
We could break it all down, figure out what's really going on and what it all means for you,
Yeah.
and more importantly, how to spot opportunities even when things feel a bit chaotic.
Exactly. That's what we're here to do, give you the insights you need to make smart decisions.
All right, so let's jump right in. The Nifty had a bit of a bumpy week, wouldn't you
Yeah,
say?
yeah.
It fluctuated, what was it, within a 721 point range
Yeah, 721 point range.
and ended up closing with, well, a slight
That's
loss,
slight loss.
but there's a twist, isn't
Yeah. Well, the interesting thing is the India VIX, which, measures market volatility, it actually declined.
there?
So that kind of suggests that maybe we're moving into like a calmer phase.
Okay, so like the market's taking a breather after a crazy sprint.
Yeah, exactly.
Makes sense. But does that mean things are going to get, I don't know, boring?
hmm
I mean, where's the excitement in a calm market?
Well, there's always something to watch for. See, even when things seem calm, understanding the forces at play, that's what's crucial.
Right.
Think of it like, imagine you're at an auction, everyone's bidding on, I don't know, this amazing like antique vase. Right. And there's this back and forth. Buyers want to push the price up, sellers are trying to hold it down. That creates, a range where the price just kind of bounces around. And in the market, we call these price ranges support and resistance levels.
So support is like the floor of the auction, where buyers are like, okay, if it dips below this, I'm snapping it up.
Mm.
And resistance is like the ceiling.
Right.
Sellers are like, all right, if it hits this price, I'm cashing out.
Exactly.
Makes sense.
And right now, the Nifty is facing some pretty strong resistance. It recently dipped below its 20-week moving average, which sits, I believe, around 24,775.
Okay.
And this moving average, it acts like a kind of like a key indicator of the market's overall trend.
All right.
Think of it like a report card,
Right.
telling us whether the market's generally, bullish or bearish.
Okay. So breaking below this average, is that like getting a failing grade?
Not exactly failing, but definitely a warning sign.
Mhm.
It suggests that maybe that upward momentum is weakening.
Okay.
And to add to that, we're also seeing something called a trend line shift at this level. What was previously support has now flipped to become resistance.
Okay, hold on. We got to break down this whole trend line shift thing.
Yeah.
Sounds a little bit like market jargon to me.
Sure, sure. Imagine you're drawing a line connecting the lowest points of the Nifty's price chart, right, over the past few months. That line acts like a floor. It was
Yeah.
preventing the Nifty from falling further.
Mm.
But now that we've broken below it, that line has flipped. Like the floor has turned into a ceiling, making it harder for the Nifty to rally.
So it's like the Nifty's trying to climb this wall, and that trend line is just another layer of bricks blocking its way up.
Exactly.
Gotcha. Okay, now it gets even more interesting because there's not just one brick wall here. There's a whole cluster of them.
Right. Exactly. We're seeing multiple resistance levels all bunched up between 24,500 and 24,750, creating this really tough zone for the Nifty to break through.
Okay.
So while we might see, some short-term bounces, a sustained rally, it seems unlikely until the Nifty can smash through that zone.
All right, so we've got resistance above. What about below? Is there anything stopping the Nifty from taking a bigger tumble?
Yeah. Our analysis shows a pretty crucial support level around 23,800. This is like a safety net. If we fall below this level, it could signal, a deeper correction, possibly even further declines.
Okay, so it's like the Nifty's walking a tightrope right now.
Yeah, exactly.
Resistance above, support below. It's a precarious situation. What does this all mean for the big picture? Should we be, heading for the bunkers, or is there still a chance to ride some waves?
Well, it's not all doom and gloom. While that sustained rally seems unlikely, at least in the near term, we can still expect to see some intermittent rebounds.
Okay.
Like the Nifty's taking a few steps back to gather momentum before, potentially attempting another climb.
So there's still a chance to catch a ride on those rebounds, even if it's not a smooth journey all the way up.
Exactly. But the key here is don't blindly chase those rebounds. Remember, sustained upward movement is unlikely until we break through that tough resistance zone we talked about.
Right.
Instead of, getting caught up in those short-term swings, focus on protecting any gains you make during those rebounds and just staying strategic.
Okay, so caution is key in this environment. But if we're not just chasing rebounds, what's a smarter approach to navigating this market roller coaster? We need a strategy, right?
Mm.
Something to help us ride the waves instead of getting tossed around.
That's where the concept of sector rotation comes in.
Ooh, sector rotation. That sounds interesting. Tell me more.
It's all about shifting your investments between different sectors of the market based on their relative strength, their potential for growth.
So like diversifying your portfolio, but on a sector level. Instead of betting on the overall market direction, you're focusing on the areas that are showing the most promise at any given time.
Exactly.
So in a volatile market like this, sector rotation can help us, I don't know, capitalize on opportunities even when the overall market isn't necessarily trending upwards. Kind of like picking the winning horses in a race, even if the whole racetrack is a bit muddy.
That's a great analogy. And to get a clear picture of, which sectors are leading and which are lagging, we can turn to a powerful tool known as relative rotation graphs, RRGs for short.
RRGs. Okay, that sounds pretty technical.
Yeah.
Can you break it down for us in a way that even someone who's, just starting out with investing can understand?
Absolutely. Think of an RRG like a radar screen, like the ones you see in those old spy movies, right? It tracks the performance of different sectors compared to a benchmark index, in this case, the Nifty 500.
Right.
And it helps us visualize which sectors are, gaining momentum, which are weakening, which are lagging behind.
So it's like a bird's eye view of the market, showing us which sectors are, I don't know, soaring high and which ones are, shall we say, stuck in the hangar.
You got it.
Okay, so spill the beans. Looking at the latest RRG analysis, which sectors are looking strong and ready for takeoff?
Well, the financial services, IT, and pharma sectors, they're all showing strength, suggesting they have the potential to outperform the broader market in the coming months.
So those are the sectors to watch if we're looking for potential growth opportunities.
Exactly. But on the flip side, the consumption and FMCG sectors, they're showing signs of weakening.
Okay, so steer towards finance, IT, and pharma, and be wary of consumption and FMCG. What about the other sectors? Where do they fall on our RRG radar?
Well, the auto, commodities, energy, media, infrastructure, realty, and PSE sectors are all currently lagging.
So those are the sectors to approach with a bit more caution. But there's always a silver lining, right? Are there any sectors showing signs of improvement, even if they're not quite in the leading category yet?
Yeah, the PSU bank, metal, and bank indices, they're all showing signs of improvement, which could signal potential opportunities down the line.
Interesting. So even in a volatile market, there are still pockets of potential growth and recovery. It's all about being strategic and knowing where to look.
Exactly. And that's the key takeaway here. Sector rotation, it's a powerful strategy, especially for navigating, these turbulent times in the market.
Right.
By understanding the dynamics of different sectors, using tools like RRGs, we can make informed decisions and potentially, position ourselves for success.
Absolutely. But before we get carried away, got to make sure everyone understands, this deep dive is purely for informational purposes.
Right.
We are not financial advisors, and the insights we've shared are, well, they're based on analysis, not personalized financial advice.
Right.
It's crucial for every investor to do their own research, consider their individual risk tolerance, and, consult with a financial professional if needed.
Couldn't have said it better myself. We're here to equip you with knowledge and tools, but ultimately the decisions are yours to make. And speaking of decisions, this brings up an important question for you.
Oh, go on.
Considering everything we've talked about, the market trends, the RRG insights, which sectors are you most interested in exploring further and why?
That's a great question to ponder. Take some time to reflect on your investment goals, risk tolerance, and all the information we've covered today. And remember, the market is constantly evolving, so stay informed, adapt your strategy, and never stop learning.
Yeah, never stop learning. Welcome back to our deep dive, into navigating this crazy market roller coaster. We've covered a lot of ground already, from understanding the overall sentiment to exploring this whole idea of sector rotation.
Yeah, it's been a wild ride so far, but we're just getting started, right? Now that we have our RRG radar set up, let's zoom in on those high-flying sectors, see what's really fueling their ascent.
Right.
I'm especially curious about financial services. They seem to be like defying gravity even with all this turbulence going on.
It's pretty fascinating, isn't it?
Yeah.
There are a few key factors driving this outperformance. One major tailwind is the robust credit growth we're seeing. Businesses and individuals, they're borrowing more, and that translates into more business for, banks and other financial
And
institutions.
so more loans, more profits for these financial players, right? It's like a rising tide lifting all boats.
Yeah, exactly. And another interesting dynamic is the market's reaction to, those US election results.
Right. Mhm.
While some sectors are a bit hesitant, financial services seem to be embracing the outcome.
That makes sense. I mean, political stability, especially in a major economy like the U.S., that can boost investor confidence,
No,
right?
exactly.
And that confidence often leads to more investment activity, which, well, that directly benefits the financial sector.
Yeah. But there's more to the story than just loans and politics. We
Right.
can't overlook, the impact of this ongoing digital revolution that's happening in the financial services industry. Fintech, online banking, mobile payments, all of that. These innovations are not only like streamlining operations, but they're creating entirely new revenue streams, expanding their reach to customers.
So it's not just about, traditional banking anymore. They're riding the wave of technology,
Yeah.
adapting to how people, manage their money today.
Mm-hmm.
That's smart.
Yeah. And all these factors combined paint a pretty compelling picture of why this sector might continue to outperform in the coming months.
Yeah, it's definitely something to consider, you know, for anyone looking to ride this wave. But of course, got to do your research, right? Look into specific companies within the sector before making any decisions.
Of course, of course. Sector trends are, a helpful starting point.
Right,
But the performance of individual companies, that's what ultimately counts.
for sure, for sure. Okay, let's switch gears a bit and talk about another sector that's catching everyone's eye, IT. Our analysis highlighted its strength and potential for continued growth. So what's fueling all this optimism?
Well, the IT sector has always been a major player in the Indian economy. And with, the world becoming increasingly digital, it seems like they're in the perfect position to really capitalize on that trend.
Right.
Indian IT companies, they have a solid reputation, for their expertise, their cost effectiveness, innovative solutions. They're really sought after by businesses across all sorts of industries and countries.
Yeah, it's like India is becoming the go-to destination for all things tech. From software development to cloud computing to data analytics, Indian companies are right at the forefront of it all.
And let's not forget about those booming fields of AI and machine learning. These are areas where Indian IT companies really excel. They're not just providing services, they're actually developing, these cutting edge solutions that are shaping the future.
So it's not just about, keeping up with the pace of technology. They're setting the pace.
Hmm.
That's impressive.
Yeah, it's pretty incredible. And with technology evolving faster than ever before, this demand for those digital solutions, it's only going to grow.
Right.
So it creates a very, very favorable outlook for the IT sector in the long run.
Okay, so we've got financial services, we've got IT, both showing promising signs. But what about pharma? Our RRG analysis also flagged this as a sector with potential.
Yeah, pharma is another interesting one. India is already a major, major player in the global pharmaceutical industry,
You're right.
known for, its cost-effective manufacturing and research capabilities.
Mhm.
And with healthcare becoming increasingly, important worldwide, the demand for their products, for their services, it's skyrocketing.
Yeah. The pandemic really, brought to light how crucial it is to have a strong healthcare system and access to affordable medicines. And Indian pharma companies have really stepped up to meet that global demand.
Absolutely. They've been, instrumental in ramping up production of essential medicines, vaccines, all of that. They've really proven themselves as reliable suppliers on a global scale.
So it's not just about domestic demand. Indian pharma is making a real difference in the global healthcare landscape.
Hmm.
That's a powerful story.
Yeah, for sure. And this global reach, it's a significant strength of the Indian pharma sector.
Yeah.
It allows them to diversify their revenue streams, tap into new markets, which is essential for sustained growth.
Absolutely. All right, so we've got financial services, IT, and pharma all looking strong, ready to ride this market wave. But as we've discussed, the market's constantly changing. What's hot today might not be hot tomorrow.
Exactly.
So it's crucial to, stay informed, keep an eye on those sector trends, and be ready to adapt our strategies as needed.
Couldn't agree more. Now, in the final part of our deep dive, we're gonna shift our focus to those sectors that are currently facing headwinds,
Right.
and we'll explore the factors that are contributing to their underperformance.
Right.
We'll equip you with the knowledge you need to navigate those potential dips in the roller coaster.
Awesome. Stay tuned, folks. We'll be right back to uncover the other side of the market story. Welcome back to the final part of our deep dive, navigating this market roller coaster. So far, we've explored those sectors that are like soaring high, defying, all those market jitters. But let's face it, every roller coaster has its dips, its turns, and some sectors just aren't having such a smooth ride right now.
Yeah, absolutely. We've talked about the high flyers, but it's equally important to understand which sectors are facing headwinds. Our RRG analysis highlighted, consumption in FMCG as areas of potential weakness. So let's take a closer look at what's causing this slowdown.
Yeah, I'm curious about that. I mean, these sectors usually do pretty well, right? I mean,
Yeah.
people always need groceries, everyday essentials. So what's changed?
Well, one major factor is the elephant in the room,
Yep.
inflation.
Right.
Rising prices are putting a real strain on consumer spending, especially on those discretionary items.
Makes sense.
People are tightening their belts, becoming more cautious about where they spend their money.
Yeah, when you see those grocery bills going up, you might think twice before grabbing that extra bag of chips or, that fancy coffee. It's all about prioritizing those essential needs.
Exactly. And this cautious consumer sentiment, it's having a ripple effect on the demand for consumer goods, FMCG products. And it's not just about groceries either. We're seeing a slowdown in demand for durable goods like electronics, appliances, those big ticket purchases. They're often the first to be put on hold when people are feeling a little uncertain about their finances.
Yeah, like hitting the pause button on those, nice to have items and just focusing on the must-haves.
Exactly.
But inflation isn't the only culprit here, is it?
You're right. We also have to consider the impact of rising interest rates.
Right.
As central banks try to tame inflation, they raise borrowing costs. This makes it more expensive for businesses to operate and for consumers to finance purchases. So it's a double whammy for these sectors: reduced consumer spending and higher operating costs for businesses.
So it's like a squeeze play from both sides. Consumers are hesitant to spend, businesses are facing pressure on their margins. No wonder these sectors are feeling the heat. But are consumption and FMCG the only ones we should be, watching out for?
Not quite. Our analysis also showed that the auto, commodities, energy, media, infrastructure, realty, and PSE sectors are currently lagging. They're all facing their own unique challenges. Some are what we call cyclical sectors, meaning their performance is very closely tied to the overall economic cycle. So when the economy slows down, like it is now, these sectors tend to underperform.
So they're more vulnerable to those economic ups and downs, kind of like being on a smaller roller coaster within the bigger market roller coaster.
A great way to put it. And on top of that, we're also seeing sector specific challenges. For instance, the auto sector is grappling with supply chain disruptions, rising input costs, making it harder for them to produce and sell cars at competitive prices.
Right. And the real estate sector, which, has been booming in recent years,
Yeah.
is now facing headwinds from those rising interest rates. It's becoming more expensive for people to get mortgages, which, well, it cools down demand.
Exactly. And the energy sector, while benefiting from high oil and gas prices, is facing pressure from that global shift towards renewable energy sources. It's a complex landscape with a lot of moving parts.
It really is. So it's a mixed bag of factors impacting these lagging sectors, but the common theme seems to be economic uncertainty and those sector specific hurdles. But hey, even with these dips and turns, doesn't this like reinforce the power of sector rotation? If we understand these dynamics, we can strategically, shift our investments toward the sectors that are better positioned for growth.
That's the beauty of sector rotation. It's all about adapting to that ever-changing market landscape,
Yeah.
making informed decisions based on the information we have. Remember, knowledge is power, and the more we understand about these sector dynamics, the better equipped we are to navigate those market twists and turns.
Yeah, absolutely. It's like having a roadmap for the roller coaster, right? We can anticipate those drops, those curves, and maybe even enjoy the ride a little more.
Exactly. And as we wrap up this deep dive, I want to leave you with this thought. We've explored various sectors, analyzed their strengths and weaknesses, discussed strategies, all of that. But the most crucial factor in your investment journey is, well, it's you.
Me. What do you mean?
I mean your individual goals, your risk tolerance, your investment horizon. These are your guiding principles, the compass that should guide your investment decisions.
I can
No matter what the market throws your way, staying true to your own investment philosophy is key.
So while it's important to stay informed, adapt to changing market conditions, we shouldn't lose sight of our own, personal financial goals and risk appetite.
Precisely.
Yeah.
The market might be a roller coaster, but you're the conductor. You decide which ride to take, how fast you want to go.
Right.
By combining knowledge with self-awareness, you can navigate the market with confidence and purpose.
Well said. And that wraps up our deep dive into navigating this market roller coaster. We hope this has given you some valuable insights, equipped you with the knowledge you need to make smarter investment decisions. Remember, stay curious, stay informed, and never stop learning.
And most importantly, happy investing.